Hey guys, in this video we're going to talk about tax payments, and specifically what we want you to do is just to understand the logistics. And you might already understand the logistics of tax payments, but what I've found as a practitioner is a lot of clients really don't understand it. So instead of just skipping this section here, we thought we'd take some time here to help you understand how tax payments actually work, just in case you're one of those individuals that don't really know how it really works from a tax perspective. So let's talk about how tax payments actually work. So typically what happens is if you have a regular W-2 job, you get a gross pay. But before you see that gross pay, there are some calculations that are done by your employer. And from your gross pay, we take out what we call pre-tax deductions. So pre-tax deductions would be like health insurance premium, retirement savings amounts into your 401k or 403b. You might have some other deductions that you can take tax-free based on the tax law. So we subtract that from your paycheck. Then what happens is we also subtract your tax withholdings. And so what the government gives to your employer is basically a table that says, if this person makes this amount of money, this is how much you should withhold from their paycheck, every paycheck. And then that's kind of how they come up with the number. So your company's not just randomly picking those numbers. It's a number that comes from the Internal Revenue Service. So that is withheld from your paycheck. And then you might have some after-tax deductions for, like, maybe you have cancer care insurance, which is not a pre-tax deduction, it's an after-tax deduction. You might have some things that you are paying, so like a parking permit might be an after-tax deduction. So there are some after-tax deductions that also get taken away from your gross paycheck. Once all of those calculations are complete, then your employer will give you your net paycheck. So they'll direct deposit or give you a hard check of your net paycheck after all of these deductions. The key thing here for tax purposes is that that tax withholding is applied to your tax return as a tax prepayment. So what essentially is happening is as you get paid, these tax withholdings are sent to the Department of Treasury, and it's almost like a savings account. It's not really a savings account, but it's like a savings account. You're depositing $1,000 this paycheck. The next paycheck rolls around, you're depositing another $1,000, and then the next paycheck rolls around, you're depositing another $1,000. So at the end of the year, you might have deposited, let's just say, $12,000 of taxes with the Department of Treasury. So the Department of Treasury has $12,000 of your money, but they don't know what to do with it because they don't know if that's their money or if some of it needs to be returned to you because you overpaid. So that's kind of how taxes work. It's not that, a portion of your paycheck is calculated and that's the tax. I think a lot of clients think that that's how it works, but really we're just sending it to the government because the government doesn't trust us to pay them that one lump sum. So we got to pay them as we earn, and then they hold that money essentially. And then when you do your tax returns, they reconcile how much you should have paid with how much you did pay to get either a refund or the tax due. So that amount that is withheld is accumulated throughout the year, and that information is then transmitted to you as a taxpayer, for instance, on a W-2 box 2. So on box 2, it says how much they withheld from your paycheck for federal income taxes. Then we, as preparers, what we would do is we would take that W-2 and we would take that number on box 2 and we would send that to the 1040 box 16 or line 16. So on line 16, we would put how much your employer withheld and how much you need to credit to that tax return. So again, it's not just that we're paying taxes. These are withholdings for taxes that we haven't even calculated yet. Now, there are some other prepayment options as well. So that's the biggest one for a majority of taxpayers in the United States because they mostly have W-2 earnings or W-2 jobs. But other ways that we can also make sure that our prepayments are with the Federal Reserve is that we could do quarterly estimated tax payments. Quarterly estimated tax payments are usually for those individuals who are self-employed or they make a lot of money in other places that doesn't include their W-2 job. So if you have that, you must pay every quarter a portion of taxes that you would have owed during that quarter. So if we think about it, a small business owner is making money all year long, but they're not getting a W-2 paycheck. What they're doing is they're just taking money out of the bank account and putting it in their pocket and then using that to pay their personal expenses. And because of that, taxes weren't taken out for that money. So quarterly estimated tax payments, what they do is they figure out, okay, how much taxes am I going to owe on this money? And then they send a check once a quarter to the IRS, Department of Treasury, for that amount. So that's another way that we can prepay our taxes during the year before we calculate the tax return. The next thing is a withdrawal from a retirement account or a pension. Typically, if it needs to be taxed, your brokerage firm would withhold some portion of that tax payment and then send that to the government on your behalf. Kind of the same thing like a W-2 income. And then the last one here is credit. So other prepayment options is credits. Maybe you qualify for a credit. If you qualify for a credit, that would be applied as a prepayment as well. So to help you understand kind of tax payments overall, if you have a traditional job that issues a W-2 to you at the end of the year, your estimated taxes that will be due at the end of each year has already been taken out of your paycheck. If you are self-employed, then you may need to make quarterly estimated tax payments for taxes that you will owe. Other specific income items may require the provider of the income to withhold taxes from your distributions. They will submit them directly to the Department of Treasury. So for instance, that brokerage firm that you have your retirement account is obligated to withhold some taxes from that distribution and send it to the Department of Treasury on your behalf. And there are other instances where that might occur as well. Technically, nobody really knows what you will owe on your taxes until the end of the tax year. We, as tax professionals, can only estimate the amount, but we really can't predict it. We don't have a mirror ball or a crystal globe that tells us what your taxes are going to be. And if anybody says that they can tell you what your taxes are going to be before the end of the year, they're probably not a tax professional. The only thing that we can do is estimate it, because we know that our clients sometimes make weird decisions towards the end of the year that just messes up that estimate at the end of the day. They buy a new car, they buy a new home, they decide to withdraw from their retirement account when they're 27, thereby pulling off a penalty for early withdrawal of a retirement. So we really never know until the books are closed and we start gathering the data to put together a tax return for our client. So it's very important you understand that when we take taxes out of someone's paycheck, it's just an estimate. We don't know if that's what they're going to have to pay at the end of the year, but the government wants something versus nothing, okay? So that's this lesson on tax payment. I hope you have a better understanding of how tax payments work. That way, if a client asks you why they have to pay when they've been paying on their paychecks, you can tell them that it was just an estimate and it wasn't really actually the taxes that they would owe at the end of the year. Until then, we will see you in the next video.